Welcome to the BF Anderson Technical Report for May 31st. Things are changing. This is what we really as investors need to understand, that the only constant is change. Now, what I have here is a graph of the 30-year Treasury bond yield going back to 1981. Now realize we have been declining, interest rates have been declining since 82, all the way down to 2016, where it made a low, an all-time low, and now has turned up. And the last time this happened was 1932. The Great Depression, interest rates got down to around 2% on the 10-year Treasury, then turned up and climbed until 82, so it was a 50-year trend. This trend is approximately a 36-year trend, and where interest rates have declined. So the point here is that when interest rates decline, certain investment strategies work better than other strategies. Mainly, interest rates decline because there's a lot of fear. Interest rates rise because there's greed. So are we seeing a long-term turn up here in interest rates? This can go on for a very long period of time. What it's basically saying is that investor behavior is changing. So all of these bond funds and all of these income-oriented strategies are going to have a headwind, whereas for the last 36 years, they've had a tailwind. Things are definitely changing. Now, simultaneously, I don't think it's any coincidence that the small cap stocks measured by the S&P 600 small cap index, and you could also look at the Russell 2000, these stocks are hitting all-time new highs. Now, this is approximately a 24-year-old index, and this is a 24-year high. So this is really a very, very positive sign that we're seeing here. And I believe the reason is that as interest rates rise, it means that economic activity is picking up, therefore confidence picks up, therefore people start moving more into the smaller companies. Now remember here, the greatest investments are the ones where you find something small that becomes big. Also, corporate earnings in the most recent quarter were excellent, and also with the strong economy, you also have the transports somewhat confirming the what we're looking at on the small caps. But you can see the beautiful trend here. We made a low here back in February, higher low, holding the trend line, and now breaking out to all-time new highs. This is very bullish and indicates a bull market. Now, just to kind of keep an eye on the transports, we want to look at FedEx Corp. You can see here using the 1020, this is a monthly graph now. This is a monthly price movement in FedEx. And we use something called a death cross and then a golden cross. Now, we got a golden cross on FedEx in the latter part of 2016. Now, you have to realize that Brexit, which is Great Britain leaving the euro, is somewhat of an indication of a change, another change, more away from socialism, more towards capitalism, and this is a swing of the pendulum. So we're seeing that in the market as we speak. Now, we need to mention here that, bear markets are devastating. However, fortunately, they're somewhat rare. But in 1929, the stocks lost 89% of their value. And it hit Main Street really hard. I mean, it was a really difficult period. Now, I'm using the NASDAQ here to make a point. But in 2000, with the dot-coms, there was a 50% decline. And in 2008, you had the financials, which was a 58% decline. So you can see here, here's the bear market of 2000. Here's the bear market of 08, 07. And then we come out of it, and we start to rally. And then we go into another mini bear market here. But if you look at this indicator, which again, this is the 10-20, the 10-month moving average versus the 20-month, we are on a golden cross, and this looks nothing, absolutely nothing like this over here. Now, can this morph into a formation like this? Absolutely, positively, yes. But it's not there today. And I think you take this a day at a time. Now, I think this is really an important analysis that I did here recently. If you go back and look at basing periods, in other words, the reason this is important is you have to understand human behavior. The average individual, and I will say that the masses are always wrong, and we all know that the masses are going into index funds, and the masses want to be interested in things like Bitcoin, and the masses are not buying stocks. They are not buying stocks. Now, if you go back and look at these basing periods, and I went back all the way back to 1902. So if you look at some of the prior basing periods, like the market hit a high in 1966, and I'm using the Dow on that one because the NASDAQ wasn't even around in 1966. But the base lasted 17 years, and then we came out of it in 1983. Then we went into a 6-year base starting in 1985, which lasted 6 years. Now, you have to understand that the average investor out there is very frustrated. He's not getting immediate gratification, doing other things, finding other things to invest in, and is going to miss a major bull market is what really ends up happening here. So you can see after this base of 6 years, then we rallied for 9 years up until 2000. However, this base here that started in 1997 is a 20-year base. So this is a 6-year base that resulted in a 9-year bull market. So there's a correlation here of 1.5, 6-year base, 1.5 times 6-year base gives you 9-year rally, because the theory is that the longer the base, the greater the race. Well, we've had a 20-year base. So if you use the same analysis, and if everything's proportional, that could mean a 30-year bull market. And we're only into this breakout 1.5 years. So this could be the beginning of a major long-term bull market that will certainly be my last bull market, and I just think it's something to be aware of. But market history is all we have to analyze investor behavior, because I always hear people say to me, you know, it's different this time, things are different this time, so forth, so on. Well, let me tell you what doesn't change. Human behavior does not change. And so what's happened here in the last 20 years is people have become very frustrated with the stock market. You know, we've had 1, 2, 3 bear markets in a 20-year period. This is very similar to the Great Depression, to be frank with you. And so we break out of it, and so all these people that are in bond funds, and as interest rates rise, are they going to start coming into the market? We will see, but it is an interesting analysis. So we could be looking at a long-term bull market here. Okay, the top 5 watch list is Axon Enterprise is number 1 on the list. We own this stock, for full disclosure. Our clients own this stock. It has been absolutely fantastic. Smoke up a chimney. Again, this is the old taser, and they're getting very heavy into videos for police officers and military. This is a healthcare stock called Biomed. As you can see, been very, very strong. They have a heart pump that is a breakthrough technology. Here we have an integrated oil and gas. Again, the oil and gas stocks have really fallen off the list because the price of oil has turned down ever since the Saudis and Russia announced their new production plans. So anyway, you can kind of see it is somewhat rolling over. I think I'd be a little careful with the energy area. Netflix continues to make the list. It's just been a very powerful company. It is a large cap, and we all know what Netflix is. Now, one other energy stock that's on here isn't more of a refiner, is Valero Energy, and you can see that it's actually looking pretty darn good. So in conclusion, what I'm saying here is that we've been in a, the market consolidates after a big up move. 2017, we had a big up move. Now we're consolidating, and we're wanting to see if we're going to break out and continue the uptrend. I think things are looking good. Let me know if you have any questions.